Well, for those who do not know, I am Al Brooks, and today I'm going to be talking about trading when a market is in a bull channel. I'll begin by describing what I mean by bull channel. It's basically a chart that begins in the lower left and goes up to the upper right. And then I classify bull channels. There's just a traditional bull channel, a term that everybody uses. And then I subdivide bull channels into two other types of channels. One is a very tight bull channel, which is a small pullback bull trend, a trend where there are pullbacks. So it's not in a breakout phase, but the pullbacks are small. And then at the other extreme, there are bull channels that are so broad that they look more like trading ranges than like bull trends. So this is a pretty typical bull channel. We have a series of higher highs and higher lows, and the chart begins in the lower left and it works to the upper right. And I think of every bull trend as beginning with some kind of a breakout. Here we have a breakout that is 3 bars tall. Sometimes the breakout can be 1 bar, sometimes it could be several bars, sometimes the bars can be small, sometimes they can be big. But in my mind, I think every trend begins with some kind of a breakout. It's a consensus, it's an agreement that the market is about to begin a trend. And the bears are giving up and the bulls are getting aggressive. And at some point you get a pullback. Once you get a pullback, the market is transitioning from a very strong bull trend, a bull breakout, into a channel. And also I want to say one other thing about bull breakouts. I think of every trend bar, every bar with a bull body, for example, as a breakout. It can be a 1 bar breakout, it can be a multi-bar breakout. But not all trend bars and not all breakouts succeed. In fact, most do not. A pullback in a bull trend is when the low of a bar goes below the low of a prior bar. And once a breakout starts to have pullbacks, I no longer think of it as a breakout. I think the market is evolving into a channel. And sometimes you'll get a 1 bar pullback and then the market goes up. Sometimes you'll get a 5 or 10 bar pullback. And you're looking for a higher low and then a higher high. And once you start to get higher lows and higher highs, the market's in a bull channel. And here we got a spike, a breakout. Another term for a breakout is a spike. Once you get a pullback, you're in a channel. And then once you get a series of higher highs and higher lows, it's obviously a bull trend, a channel. Excuse me. Typically, whenever I see a breakout and I think we have a higher low, we might be forming a channel, I'm always looking for 3 pushes up. 1, 2, 3. It's pretty common that once you've had 3 pushes up, you'll start to attract some profit taking. And any channel that has 3 legs up like that, I start to use the term wedge. And most of the time, the lines are not convergent, but some of the times they are. And I know a lot of people like to use the word wedge for channels where the lines are converging, but they don't have to be. That's ideal, but very few things in trading are ideal. Signal bars don't look right. Channels don't look right. Wedges don't look right. Nothing is going. If you're looking for things that look right, you're never going to trade. So you got to be very, very flexible with what you're doing. Anyway, breakout is the strongest form of a trend. Once you start to have pullbacks, you're in a channel, and that is a weaker form of a trend. And if the channel has legs down that are pretty far, even though it's a bull trend, you'll get bears selling as well as the bulls buying. Actually, this is not. Let me do it this way.
Would you consider those first three bull bars a wedge?
I'm sorry, what?
Would you consider those 3 first bull bars a wedge? The spike? You talking about the spike?
Yeah, spike. Yeah, I call that a spike or a breakout.
Would you consider that a wedge at all?
A wedge? No, you mean the 3 bars alone?
Yeah.
No, I would look at that and say, that's a surprise. And whenever I look at something and think of it as a surprise, I assume that there's a consensus that something has changed. And whenever there's any kind of a surprise in the market, I'm always expecting that there'll be follow-through, that there'll be at least a second leg up. And the reason for that is if you're short and you see this, what are you thinking? You're thinking, I'm screwed, right? Right? You're thinking, I hope that there's a pullback so I can get out and buy back my shorts with a smaller loss, right? So you get the bears who are trapped into a bad trade hoping for any kind of a pullback that would allow them to get out with a smaller loss. So the bears want to buy, okay? And if you were bullish and you see this and you say, darn, I missed it, right? What are you thinking, right? You're thinking, I really want a pullback so I can buy, right? So the bulls are hoping for any kind of a pullback to buy. The bears are hoping for a pullback to buy. And the result is you're going to get a second leg sideways to up. Sometimes it's just sideways, but other times it can be up. Okay, whenever the market's in a bull channel, it's going to be easier to make money buying. And the stronger the channel, the more you should be focusing in on buying, okay? And you look at it and say, oh, how do I get long, right? Everybody, if it's in a trend, everybody wants to get long. The single easiest way to get long in a trend is to buy with a stop above a bull bar closing near its high, all right? So you just look, and these are many examples. You're not going to take all of these, but at some point you're saying, gosh, it's going up. It's forming higher lows. It's forming higher highs. I got to get long. What do I do? Okay? The single easiest way to do it is just be ready and look for a bar closing on or near its high and place a stop to buy one tick, or if it's a euro, if in this case it's a euro versus the dollar, 1 pip above the high of the prior bar. And once you're long, you look at a swing low, the most recent swing low, and that's where your stop goes. And you can hold for a swing, or you could scalp out. So no matter where you buy, the stop goes below the most recent swing low. And if you bought down here, and now the market's up here, your stop is here. Once the market starts to resume up reasonably strongly, you raise your stop to below the most recent swing low. And that has nothing to do with your entry price. Whether you bought here or down here, once the market is up here, your stop is down below the most recent higher low. And if you have pretty good drops on the pullbacks, you can also sell, right? Especially if you have a second sell signal. Here's a first below that bar. Here's a second below this bar, but I'd rather sell below a bar closing on or near its low. You have a higher probability of making money. So it's a bull trend, higher highs, higher lows, but easier to make money looking to buy. Sometimes you can make money selling if the legs down are deep enough. If you're selling in a bull trend like this, you're looking for scalps, right? You're not looking for the market to convert into a trend. You're simply looking for relatively quick profits. The bulls who buy can buy either for a scalp or for a swing. Okay, now I said in a bull trend, it's easier to make money buying. And what are the kinds of things that you look to see on a chart that make you think, maybe I should only buy and not think about selling, right? If most of the bars are above the moving average, here, in the past 20 bars, most of the bars are above the moving average, it's usually better only to be looking to buy, okay? And then when you have pullbacks, do the pullbacks only go a little bit below the moving average, right? And if the pullbacks are not going very far below the average price, the market is not spending much time below the average price, you should only be looking to buy. And then also, if a pullback, even if it has a lot of bear bars, if it ends and the market starts to resume up from a higher low, easier to make money looking to buy. Also, I always pay attention to trend bars, especially consecutive trend bars, especially consecutive strong trend bars. And if I'm in a bull trend and I start to see big bear bars like this, I do not want to see a second consecutive big bear bar, all right? Because if you start to get the bears controlling 2, 3, 4 bars in a row, they're taking control over the market. And so if you're not seeing consecutive big trend bars, bear trend bars, it's usually better. It's usually easier to make money only looking to buy. This bar right here is, I think, pretty interesting. All right. So here we have 5 consecutive bear bars, and everybody's wondering, is the market going to form a bear trend? Right. And when you see this bar, and you're thinking about shorting, you're probably thinking, I really need one more bar like that, and if I get it, I'm going to short. Okay? And that happens a lot in trading, where you look at the chart and you're thinking, it's turning into a bear trend. I got 5 bear bars, right? But I really, it's still a higher low. It's still about a 50% pullback. I really want one more bar, right? And whenever I think that to myself, what am I going to do? I'm going to buy. Right? Because the bears need one more bar. It's a bull trend. What is the probability? Is the probability that they're going to get their one more bar and the bull trend is going to become a bear trend? Or is the probability that the market's going to continue to do what it's been doing? Markets have inertia. They tend to continue to do what they've been doing. If the market's going sideways, it's probably going to continue sideways. If it's going down, it's probably going to continue down. If it's going up, it's probably going to continue up. And whenever it's doing something, it's always trying to do something else. So if it's in a bull trend, it's always going to be trying to convert into a bear trend. But you have to bet that every time it gets really close to becoming a bear trend, it's not going to become a bear trend. So if you see something particularly bearish and the market's in a bull trend, and you're deciding, do I buy or sell? I'm always looking to buy. So if I see a bar like that, a lot of times I'll simply buy the market as soon as the bar closes. Other times I'll wait for a reversal up and then buy above the reversal up. I want to say one other thing about these bull trends. I also pay attention to the pullback and compare it to the breakout point. Here we got a breakout to a new high. So this is the breakout point. The market reversed down, but we continued up. So this is a pullback. So we have a breakout point and a pullback. I always look at the bottom of the pullback and the top of the breakout point. If they overlap like this, then I'm more willing to sell new highs. Okay? So I call that a stairs pattern. Stairs pattern, we're stair stepping up. But if I see a pullback and it ends here, and the bull trend continues up, and the pullback does not fall below the breakout point, okay, that's a sign of a very strong bull trend, because there are always bears who are shorting. And that means during this breakout here, there are bears who are going to sell this high. And they're going to sell more higher, because most of the time, if you're getting a deep pullback like this, you'll get other deep pullbacks. So if you sell it this high and it goes above this bar, one of two things is going to happen. It's going to go down and you make a profit, or it goes up, you sell more, and you know it's going to come back down, and you can make a profit on the second time that you sold, expecting it to fall below the breakout point. So if a trend is not pulling back below breakout points, it's a very strong trend, and you should only be looking to buy. Here we're pulling back below breakout points, so bears are selling. So if the pullbacks are relatively big, the bears can sell. They're not looking for a trend. They're not looking for a swing. They're looking for a scalp. This is what I was talking about. Here we broke out to a new high, but we pulled back below the old high. And once that happens, I start referring to this as a stairs type of channel. And if the market is stair stepping up like that, it's always easier to make money buying, but you can make money selling. A bear, he'll sell at the prior high and sell more higher, expecting pullbacks to fall below the breakout point. He can get out break even on his first sell and with a profit on his higher sell. In general, if I see this, that's a surprise. It's a surprisingly strong breakout. I'm not going to be selling there. However, if I see this, a pullback below the breakout point, I probably will start to look to sell at a new high. sell the breakout point. If it keeps going up, you sell more, expecting it to pull back below the breakout point. Same thing. So bears, if they see deep pullbacks, they'll place a limit order to sell at the prior high, betting that the breakout will be profitable. If they sell it, they can sell more higher. For example, they might sell, this is a euro versus the dollar, they might sell more 10 or 20 pips higher. If this is a daily chart, they might sell more 50 or 100 pips higher, confident that there's going to be a pullback and it will fall below the breakout point, and that will allow them to get out break even on their first sell and with a profit on their higher sell. So a bear who sold here was hoping it would go here. He could take a profit down here. If instead it goes up here, he sells more, confident it'll come back to his first price. He can get out break even on his first price and with a profit on his higher short. So bull trend, but bears can short. Here we have a breakout that is not nearly as strong as in the other example, but we have a series of 7 bull trend bars, a couple of them with decent sized bodies, several bars closing on their highs. So you look at that and you say, that's pretty surprisingly strong. And if it's surprisingly strong, you're expecting at least a small second leg up. Even though it doesn't really look like a breakout, we have small bodies and tails, I would still call that a breakout. And it makes me think that at some point we'll have a pullback, and once we have a pullback, we'll start getting other pullbacks, and the market will be in a bull channel. We have a bear bar here. Its low is below the low of the prior bar. So the breakout phase has probably ended, and when the breakout phase ends, you have to assume you're entering a channel phase, and that you get a series of higher highs and higher lows. You can call this a wedge bull flag. It's a pullback and a bull trend. We have 3 legs down, a bear bar, a pause, a couple more bear bars, a pause, and then a third bear bar. And now we have a pair of bull bars, so it looks like a breakout above the bull flag, probably the start of a channel. And this is I think this is an important point. You have a breakout, at some point the trend weakens into a channel, so a bull breakout and a bull channel, so it's a weaker type of trend. And 75% of the time, if the market's in a bull channel, I think of it as a bear flag. Right? 75% of the time, if you see a bull channel, you're going to get a bear breakout below the bull trend line, and you'll get a swing down. And what typically happens is you have a bull trend, a channel, a break below the bull channel, and then a conversion into a trading range. And then once it's in a trading range, traders start to think, what comes next? Is it going to be a resumption of the bull trend, or are we going to get a transition or a reversal into a bear trend? So this, when I see a breakout, I'm expecting a channel, and I know there's a 75% chance at some point we'll break below the bull channel and convert into a trading range. And once we start to trade down, I will look back at this and say that bull channel was a bull leg and what was to become a trading range. So every time I see a bull channel, I always assume that it's the start of a trading range. So every bull channel that I see, I always assume it's a bull leg and what will become a trading range, even though as it's forming, it's still a bull trend. At some point, I'm expecting a bear swing that will reverse almost the entire channel. A lot of times it reverses the entire channel or even a little bit more. And then in hindsight, you'll look at this rally and you'll say that it was a bull leg and what was to become a trading range. Okay, here we have a bar with a low above the high of the prior bar. And in fact, we have 14 consecutive bars where every low is at or above the low of the prior bar. I call that a micro channel. And within it, we have a breakout, and then we have a smaller bar. We have another breakout, another smaller bar, and then a series of bars, another breakout. So we have 3 legs up in a very tight bull trend. And when that's the case, I call it a parabolic wedge. So this is a parabolic wedge. And earlier I said that if you have a channel and it has 3 legs up in it, it's a wedge. So even though this does not have a wedge shape, we have a bull channel. We have higher lows, higher highs, 3 legs up, 1, 2, 3. So I would call this a wedge rally, a wedge bull channel, even though it does not have a wedge shape. And within it, the third leg up subdivided into a parabolic wedge. So you get a parabolic wedge nested within a bigger wedge. That is very, very climactic, and it's going to attract profit taking. I don't know if anybody was in the chat room this week on Tuesday. I said, this is the end of Tesla. It was a parabolic wedge, and I noticed I didn't trade Wednesday or Thursday, but I just knew Tesla was going to be down. And in fact, I debated shorting Tesla on Tuesday, and the easiest way to do it would have been with put spreads, but it was so overdone, I was really tempted to just short it. But if I did, and I would be thinking about it the whole time, and I wanted to be in Disneyland, I wanted to be in Universal Studios yesterday, and I just didn't want to be thinking about it, but I was so confident that Tesla was going to go down. But anyway, whenever you have a bull channel, you have to be assuming 75% chance you're going to break to the downside, and if you have a breakout above a bull channel, 75% chance the breakout is going to fail within about 5 bars. So you look at this and you say, wow, this is a really strong bull trend, right? Maybe it's going to continue up into a much stronger bull trend. It might, but only 25% chance it will. 75% chance, if you're breaking above the top of a bull channel like this, the breakout's going to fail within 5 bars, and at a minimum, you'll pull back to the middle of the channel. Usually you pull back to the bottom of the channel, and sometimes you reverse below the bottom of the channel. So you see a very strong breakout above the top of a bull channel. I'm looking for a reversal. I don't want to be selling below a bull bar, and when a trend is that strong, I typically will not sell the first reversal down, like below that bear bar. However, if we get a second reversal down with a bear body closing at its midpoint or below, I will start to short. So to me, I would short below that bear bar or below this bear bar. Here we have 4 bars without a bull body, or below that bar. I'm going to get short, taking a chance that we're going to get a couple legs down. It could be 1 pullback 2, or it could be 1 pullback 2. My general rule is if the market's in a bull trend and I'm getting a climactic reversal, I expect the reversal to have about half as many bars as the bull trend. It could have more or less, but that's my guideline. So if I see 1 pullback 2, am I going to think this is the end of the correction? No, because this is not half as many bars as there were here. So I'm going to assume 1 pullback 2 is a complex first leg down. So I'm assuming it's going to go lower. All right, you can see wedges here. Okay, we have a bull channel with 3 legs up, 1, 2, 3. So this is a wedge top. So you expect a reversal down. And we got it, however, we got a new high. This is a pretty common situation where you have a wedge top, the pink line here, okay, and we had a reversal down. I could have drawn the line in here. But instead of a bear trend, we got a new high. About half the time, if you have some kind of a wedge top, you're going to get a test of the high, or even a breakout above the high. But you still have to be assuming that we have a wedge, we're going to get a bear breakout and a couple legs down. So we have a wedge here, 75% chance you're going to get a bear breakout. Again, I don't have the line drawn in here. I should have put it there. We got a bear breakout, a couple legs down, 1 pullback 2. Does not look like enough to pull back from that big of a wedge. We got 1 more leg up, trying to break above the top of the channel. 75% chance you're going to get a reversal down. Anytime you have a wedge rally, 75% chance you're going to get a break below the bottom of the channel, which we did. So reasonable to short. This high did not go above that high. If you take that short, your stop is above that high. and you're looking for a couple legs down. It could be one pullback, two, or it could be one pullback, two. This is more like about half as many bars as there were here. Now, I said earlier that if the market's in a bull channel and you get a bull breakout, 75% chance it's going to fail within 5 bars, and you'll get a reversal down and a break below the bottom of the channel, all right? There's one exception to that rule, and this is it. When I see a bull channel, but the pullbacks are small and brief, here, 2-bar pullback, 1-bar pullback, 1-bar pullback, all right? And then here, no pullbacks at all, okay? I call that a small pullback bull trend. And if you have a small pullback bull trend and you get a breakout above the top, it's not a 75% chance the breakout will fail. It's more like 50-50. In general, if you have a bull channel and a breakout above, in general, 25% chance you're going to get an even stronger trend up, a swing up, and 75% chance you'll get a reversal down. Except in a small pullback bull trend, it's more like 50-50. In general, if the market's in a small pullback bull trend, I'm not looking to sell. I only want to buy. And remember I said every trend bar, I think of every trend bar as a breakout. So this bar is a breakout. And what did it break out of? Well, a couple things. It broke out above the high of this bar. It closed above the high of that bar. It closed above the top of the channel. And then the bar after the breakout bar has a bull body, and a bull body closing on its high. So you have a 2-bar breakout, one a big bar, second one a bull body. This breakout is probably going to have a swing up. So a breakout and a bull follow-through bar. And if ever I see a bull channel, and I see a wedge, you can call it a wedge, a bull channel, and a breakout above, and I'm looking for a couple legs up. I'm looking for more than that. I'm typically looking for a measured move up. And this breakout, I consider it a gap, and it often is a measuring gap. And the measured move is from the breakout point, I look back to the start of the channel, and I'm expecting the market to rally for about that same distance. And as soon as I see this breakout, and I'm seeing it's breaking above the bull channel, I draw that line in, because I know that's where the market is trying to go. And anytime it's trying to reverse, I'm thinking, it might be a reversal. I bet it's going to go up here. So anytime it starts to sell off, I'm looking for the sell-off to fail, and I'm looking to buy again, expecting it to get up to that measured move target. This chart I like. This is 1987, the crash. This is when I started trading. And what I like about this is we have a bull channel, fairly tight bull channel, and you can call it a wedge. And then we started to get bull bars, 2, 3, 4 bull bars. And not only bull bars, they're closing on their highs, all right? So something's going on here. The price, these bars are different from all of these bars. Here we're getting bull bear, bull bear, bull bear, okay? Here we have 2, 3, 4, 5 bull bars closing on their highs. So something is happening, something different from what has happened for the past, many years. And you're getting a bull breakout above a pretty tight bull channel. And this is, I think, the most dramatic example of a bull breakout above a bull channel that led to a successful trend. And you can see this is when the Republicans took over Congress in 1995. And this was a tremendous, tremendous bull trend up breaking above a wedge channel. I remember Prechter, the idiot wave theory guy, was talking a lot about how this is a major top and the stock market is going to lose 90%. And at the time, I was still a relatively new trader, and I'm looking at it and saying, I don't understand. Why is he saying that? It looks like it wants to go up to me. And it was an incredible rally. Okay, so at some point you have to decide that this is going to be a successful breakout. And usually once you start to get 3 or 4 bull bars closing near their highs, you have to assume it's a bull breakout. So what do? You buy with a stop above the high of any of these bars, and you just hold on. There were plenty of opportunities during that rally from 1995 to get long. And the easiest way to get long, if you're a trader, you simply place a stop to buy above the high of the prior bar. I talked about channels. This is your garden type of bull channel. You can buy and sell. If the pullbacks are pretty small, you only want to buy. If there are no pullbacks, you cannot sell. And then sometimes you have a bull channel like this where you have higher highs and higher lows, but it looks mostly sideways. It's basically a trading range that's tilted up a little bit. You trade it like a trading range. Okay, a bull channel, you get pullbacks that last a few bars. They retrace about half of the prior leg up. You can make money selling, but it's better to buy. You can sell on reversals down for scalps. Limit order bears will sell at prior highs, expecting it to retrace about half of the prior leg, and they can scalp out. But like this, when the pullbacks are small and brief, you can call it a tight bull channel, a small pullback bull trend. On a higher time frame chart, that is a micro channel on a higher time frame chart, and you're not going to be making money selling. So if you're ever in my chat room, sometimes you'll hear me say, that's a small pullback bull trend. If it's in a small pullback bull trend, I know it can last a long time, and I'm not going to sell. I'm only looking to buy. So the more our trend looks like this, the more inclined I am only to buy. And if it's extreme like this with no pullbacks, every low at or above the prior low, yes, it can be climactic and you can get a reversal, but I'm only looking to buy that until we get an obvious reversal. And then the more it looks like a trading range, even though it has higher highs and higher lows, yes, it's a bull channel, but it looks like a trading range. I'm going to trade it like a trading range. So the more it looks like this or this, I only want to buy. The more it looks like this, I'll buy or sell. And if it looks like this, where the pullbacks retrace about half of the prior rallies, I will sell, but I'd rather buy. Okay, bull channel. We have a breakout. Breakout above what? Well, breakout above a bear channel. And we also broke above that lower high in the bear trend. And then we're pulling back about half of the rally, giving it back, and we're starting to get a bull bar. So I'm going to be looking to buy with the stop. This might be a higher low after a higher high, and it could be the start of a bull channel. Whenever there's a breakout, I'm looking for a pullback and then a conversion into a channel. And a channel would be a series of higher highs and higher lows. This is stair-stepping up. We're breaking out, we're pulling back below breakout points. You could sell as well, but I'd rather be buying. And the easiest way to buy, you simply look for any kind of a pullback and then look for a bull bar closing on or near its high, and then buy with the stop above the bar, above the prior bar. So here we have a pullback. This bar went above that bar. I'm not going to take that buy because it does not have a bull body. Here, this bar went above that high, but bear body, I'm not going to buy that. Here we have a bull bar, so as soon as I see a bull bar closing near its high, I am going to be ready to put a stop to buy above the high. And you just do that all day. You don't have to take every trade, but you have to get long at some point. And these are reasonable buys. And then when it gets up to the prior high, you can either hold long or you can look at the price action and say, that's not really very strongly bullish. Maybe I'll exit at or above the prior high. So if I'm seeing a trend that looks like this, a lot of trading range price action, a lot of times going sideways, I'll typically buy and scalp out around the prior high. Another thing you can do is, once you think you're in a bull trend, if you're aggressive and experienced, you can also buy the close of every bear bar, betting that the attempt to reverse into a bear trend will fail. Or you can simply buy at the average price, betting that most of the bars are going to be above the average price and that the average price is going to go higher. Another thing that I like to do is buy with a limit order below a bull bar. So the market's trying to reverse down, probably in a bull trend, right? So anytime I see a bull bar like that, I tend to place a limit order to buy with at the low of the prior bar, betting that it's a bad sell setup and we're in a bull trend, and therefore there are probably more buyers than sellers below those bull bars. Bears, they'll scalp. As I said, they'll sell at the prior high, they'll sell more higher, and they'll get out break even when it comes back to their original entry price. They'll also sell on a reversal down when you have lots of bars with prominent tails, lots of bear bodies. You'll get some bears looking to scalp on the way down. Here we get a doji bar, they might sell below that. They prefer to sell below a bear bar like that, or a bear bar like that, or a bear bar like that. And they're just looking for scalps. They're trying to take quick profits. So they'll sell at the prior high, they'll sell on a reversal down below a bear bar, and they'll look for a very quick profit. Sometimes they'll sell, it doesn't fall far enough for a profit, and then it's trying to resume up again. If it's a second reversal up, here's a first, here's a second, especially if you have a bull bar like that, the bulls are going to buy that. And if the bulls are going to buy, if you're short, you have to get out. So that's a high 1, a high 2, and a bull trend, a bull bar near the moving average. If you're short here and you did not make enough money for a scalp out, you get out here on the resumption up. Tight bull trend. When I'm looking at this, I look at the moving average. I'm always looking at the moving average. It's a 20-bar exponential moving average. And I'm saying, yeah, we're getting reversals, but they're not going below the moving average. And they're not lasting many bars. Here, a 1-bar pullback, the bull trend tried to resume. A 1-bar pullback, you can say 3 bear bars, yeah, but only a 1-bar pullback. You know, only 1 bar made a new low. So when I'm looking at this, I'm thinking, this could be a small pullback bull trend. And it could last 5 or 10 bars, it could last all day. But whenever I'm seeing something that looks like it could be a small pullback bull trend, my inclination is to buy. And the easiest way to buy, I look for a bull bar closing near its high, especially near the moving average, and you just buy on a stop above the high of the bull bar. Yes, a lot of trading range price action, but why is every bar above the moving average? So, and why are the pullbacks lasting only 1 bar? All right, you know, I pay a lot of attention to that. So even though we're mostly sideways here, the pullbacks are small and they're brief. They only last a bar or so. And then look at this. A couple bull bars. We have a breakout. And then look at the pullback from the breakout. Okay? It did not fall below the breakout point. And that means bears who sold at this high did not make money and they had to buy back their shorts. Here, we pull back a little bit below the breakout point, but the bodies of the pullback do not overlap the bodies of the breakout point. So if this were a line chart, there would still be a gap. I call that a body gap. It's another sign of strong bulls. It's not as strong as an open gap like this, where the pullback stays above the breakout point, but it's still a sign of very strong bulls. And again, a pullback lasting only 1 bar, right? Here, no pullback at all. We have bear bars, but no pullback. Very strong bull trend, a small pullback bull trend. I only want to look to buy. In fact, here, from this bar to there, how many pullbacks do you see? How many bars fall below the low of the prior bar? 0. That's a 25-bar bull microchannel. Even though the bull bodies are small and there are a lot of bear bars, that is extremely strong buying. And if this is a 5-minute chart and you look at the 30-minute chart, this is what you see. And if you see this, are you thinking, oh my gosh, I got to sell? And you're thinking, no, I'm not going to sell at all, right? So a small pullback bull trend is always going to be a strong breakout on a higher time frame chart. And you know it's a strong breakout on a higher time frame chart. Even though you have a lot of bear bars and most of the bull bars look weak, it's part of a very, very strong bull trend. So you cannot look at the bars and say, they look crummy. You got to look at the pullbacks and say the pullbacks are really small. It's going to be a breakout on the next higher time frame. You can only buy. it's impossible to make money selling, right? Anytime you look at a chart and it's impossible to sell, you should only be looking to buy. At some point, there's going to be profit taking at the end of the day. I want to say one other point about this, okay? If you're just looking at this, it looks like it's a weak rally, and it looks like it's a low probability bet for the bulls to buy, but it keeps working higher, right? And you also look at it and you say, oh, there's probably not much potential for reward here, so the reward is probably small. So if you're buying anywhere in here, the risk is pretty big. You're thinking, the reward is small, the probability is low, but that's not true. Remember, it's a small pullback bull trend. It's a breakout on a higher time frame chart. So in fact, the probability of making money is much higher than you think, and the reward is much greater than you think. So it's not a terrible risk reward with low probability, and in fact has a high probability and a very big reward. So it's when you look at this, you got to be thinking the bars look crummy, but it's not. Right? There's actually a very high probability of making a lot of money when you see a small pullback bull trend. Again, just buy with the stop above the high of the prior bar. You can also buy bear closes, betting that the reversals will not get very far. You can buy at the market. You can buy with a limit order below the low of the prior bar, again betting that the pullbacks will not last very long. Broad bull channel. I don't want to spend a lot of time on it, plus I'm running out of time. But a broad bull channel, when you're looking at it here, the first 100 bars, it was a trading range. And within the trading range, there were smaller trading ranges. And you trade it like a trading range. You're looking to buy low, sell high, and scalp, even though it's a bull trend. Higher high, higher high, higher high, higher low, above that low, higher low, higher low. So strictly speaking, it's a broad bull channel. It's a bull trend, but it's mostly sideways, and I trade it like a trading range. You're looking to buy low, sell high, and scalp. I don't want to spend time on this. This is more trading range trading. Plus, I'm running out of time. But you're looking to buy reversals up, and you're looking to take quick profits. And even though it's a bull channel, it's so much more of a trading range than a bull trend. You're also going to be selling reversals down. And you're taking quick profits. Bottom line, the more a trend looks like this or this, you only want to buy. The more it looks like this, you can buy or sell. And if it looks like this, your common type of bull trend, easier to make money buying, but you also can sell. So, small pullback bull trend or a small pullback bull trend with no pullbacks at all, you only want to be buying. If the pullbacks retrace about half of the prior leg, you can buy and sell, but it's easier to make money buying. And if it's basically a trading range, even though it's a bull channel, you can buy and sell, but you're scalping. You're looking for quick profits. So I began by talking about a bull channel. It's a series of higher lows and higher highs. And then I talked about types of bull channels. And if a bull channel is a very tight bull channel, small pullback bull trend, you only want to be buying. If it's very, very broad, the more broad it is, the more you can buy and sell. All right, I made it to the finish line. We can take a few questions, but we'll have to clear out to let the next person in. Yes?
This is great. Could you look at the current status of the S&P on a daily and weekly and monthly?
I trade them.
Can you show us where we stand?
I do it exactly the same thing that, it doesn't matter if it's a 5-minute chart, daily chart, monthly chart, yearly chart. Back in the beginning of January, I showed an example of a yearly chart. And I'll be writing more about this soon. But I think this year, at the beginning of the year, I said that this year would probably spend a lot of time being sideways. It might even be an inside year. Well, now it's not going to be. We went above last year's high. But I think this year is going to be a trading range between 3,000 and 3,500 for the entire year. So even though we went to a new high this week, I think we've begun a trading range and there's not much left to the upside. So.
Slide 5, please.
I'm sorry, what?
Slide 5. Slide 5.
Let me see if I can get back there. This slide?
Yes, sir. Okay. And your second leg up after the first swing high, you had is above the breakout of that second.
You mean like way up here?
One to the left.
Yeah.
Right there. Okay. So when you buy in there, and if it hadn't hit your target by the time it hit the upper.
Yeah, what do you do with that bear bar?
Well, that was one of the questions. At what point would you want to be looking to exit? Understand on the.
If I think the rally is weak and I see a reversal down, I'll get up below a bear bar closing on or near its low. If this were a 5-minute, let's say it's an E-mini chart. If it's an E-mini chart, I will get out 4, 5, or 6 ticks below any bar, even a bull bar. Okay, and then if the market starts to go back up, I'll look to buy again above the high of a bull bar closing on this high.
And also, you mentioned you would be buying on that one, the bear bar underneath the EMA there to the right. That one. Would you buy the close on that?
For this bar?
Yes.
A lot of times I'll buy the close. I'll just buy the market. Just buy the market. And then if the next bar is also a bear bar,